Hi, it's Molly from the semi-retired MD team. Today's episode comes straight from our 2025 Fast Fire to Freedom Summit, featuring tax expert and real estate investor Nick Aiola. Nick breaks down the brand new tax law, what's changing, what's staying, and most importantly, how you can take advantage of 100% bonus depreciation and other strategies to save tens of thousands of dollars while building your portfolio. Whether you're brand new or scaling up, this conversation is full of insights to help you keep more money in your pocket and accelerate your path to financial freedom. Let's dive in.
Hi, everybody. Hope everybody's day is going well. I'm really excited to talk to you guys today. We'll touch on the new tax law and go through some fun stuff, as fun as taxes can be anyway. So taxes are usually more than housing, food, any other expenses that you might have. So if we can reduce that and add that much more to your budget or to recycle into investing, it only pushes you further towards your goals, whether that's retiring early, financial freedom, just wanting the ability to step back from work if you do, if that's what you want, travel, whatever it is, build a family. That's the enjoyable part. So this is a method for us to get you there. And so some of this stuff that we'll talk about today may not have 100% concrete answers on how this will be applied or how to think about it, but that's coming. As time goes on, we'll get that and we'll be able to apply it as anyone should. But just keep that in mind that this law is the starting point and we'll get more clarity as time goes on. Okay, so first notable changes here we'll talk about are tax brackets and standard deduction. Starting here because this applies to everybody, no matter what you do, no matter how you earn income, no matter what you invest in. Again, this is a good example of you're not going to feel this change. This is something that was made permanent. If you remember, before 2018, the highest tax bracket was 39.6. The tax rates looked much different. Standard deductions too. There were personal exemptions. It was all different. We've been used to this now for the past 8 years, and it seems normal now, but this was set to expire next year, or at the end of next year. So now we know that this is permanent, or as permanent as tax law can be until the next time tax law changes. So now we have top tax bracket, 37%. Standard deductions are still indexed for inflation. You can see more of the technical brackets there with the numbers and your filing statuses. But that's good news. That's good news. We know that we have a cap on the top tax rate, 37%, and that's permanent. Other notable changes, qualified opportunity zones. Maybe some of you have invested in qualified opportunity zones or heard of it. This is like a hybrid inclusion of the new bill. It does make qualified opportunity zones permanent because that also is set to expire, but with a little bit of a twist. Not only does it just make it permanent, it adds some rules that are now brand new. So this is kind of a hybrid. We have some brand new law for an existing provision that's now permanent. This is great for people who have large capital gains. So just a refresher on what an opportunity zone actually is. The opportunity zones themselves are designated by the government. You can go online, you can find like a site where you can see a map of the country and that designates opportunity zones, and you can see if any properties that you are looking to purchase are located in opportunity zones. If you already own property there, probably too late to enact this strategy. But if you're looking to purchase in an opportunity zone, this might be something you want to talk to your CPA about. So what it is it allows you to invest capital gains into an opportunity zone fund, which either you own yourself, meaning you can own a rental property. You have to structure it very specifically with entities. You own the rental property in this specific entity structure and you manage it, you do the renovation, you do everything. Or you can invest it like a syndicated opportunity zone fund, which is functions just like a normal real estate syndication where you're a limited partner, send your money. You don't have control over the day-to-day management or anything like that. But what it does is it allows you to defer the tax you would pay on the capital gain. And what's different here compared to a 1031 exchange is that you can do capital gains from any capital asset. So if you have a large stock portfolio, capital gains, or stock options that you want to sell that produce capital gains, you could do it with real estate too. That's capital gain as well. Anything that generates capital gains, crypto. We've seen people hit some home runs with crypto and now want to put some of that asset into real estate. You can do that and defer it. The difference here, that's one difference compared to a 1031. Another difference is that it doesn't defer it indefinitely. There is an end point. So this was first introduced in the Tax Cuts and Jobs Act, and it deferred taxes all the way to 2026. So at the time, it was almost a 10-year deferral, which is great. Now we're coming up on 2026. So anybody who's done this now will have to report these deferred gains on their tax returns, 2026 tax returns filed in 2027, there's going to be a lot of phantom gains or deferred gains that are now in the picture. So they're basically restarting that process. Starting in 2027, you can defer capital gains for 5 years. So if you have a large capital gain that you want to recognize, but you're not pressured to, that could be a talking point. Would this be worth it to sell, wait until 2027 and sell and push this capital gain into an opportunity zone that might allow you to kick that tax can down the road for 5 more years? It's possible. And after that 5 year, you get what's called a 10% basis step up. So it gets a little complicated here, but basically it's a 10% discount on your gain. If you sold stock or if you sold real estate or if you sold crypto or any other capital asset at a $100,000 gain, under normal circumstances, you would report that $100,000 gain on your taxes, pay your tax, and move on. Opportunity zone, you can defer that $100,000 gain. You only have to invest the gain. You don't have to invest the full amount of the proceeds. You only invest the gain into this opportunity zone, and you can defer the full $100,000 of tax for 5 years. Once you hit that 5 year point, 10% of that gain, $10,000 in this example, will be wiped out. You wouldn't have to pay tax on that. So you'd only pay tax on $90,000 of gain. So it's a freebie basis step up if you did this and you held it for 5 years and you committed to the strategy. That's a 10% basis step up. There's a 30% basis step up for rural qualified opportunity zones. This is brand new. So rural is dependent on poverty level of a certain area, population of a certain area, proximity to like a city with higher population, how far away it is from a city. So there's certain stipulations. And again, there will be, I'm assuming, interactive resources, if they're not already built for this, that you can go online and see what constitutes a rural area. But if you do this in a rural area, you get more of a benefit, with the goal being moving the money and the improvement and the investors into areas that are further away from major cities, more rural areas to develop them. So that 10% basis becomes 30% if you do that in a rural area. So you can wipe out 30% of your gain after a 5 year holding period. Opportunity zones are very complicated. We're just scratching the surface here, but just to highlight more of the changes and the rural QOZs, substantial improvement is a requirement of all opportunity zones. You have to improve the property significantly in order to qualify or have this being eligible. So for a standard qualified opportunity zone, how it's been for the last almost 10 years, you have to put into the property dollar amount, this 100%, the same amount of what the basis of the building is. And again, a little bit complicated, but let's say you buy a property for $500,000 and $400,000 is allocated to the building, $100,000 is allocated to the land. That $400,000 allocated to the building, you have to match that in improvements. So you have to put 400K into it in renovations. Significant amount. So that drives often the purchase price and the condition of the property. You have to know that you're able to do that. But again, another new benefit here, if you were to go into a rural area, quote unquote, your requirement is only 50% of that building basis. So same property, $500,000, $400,000 building basis, $100,000 land basis. You'd only have to put $200,000 of improvements into it. That's half of 50% of the building basis. So it's a significant break for the rural areas, but again, you have to want to commit to the strategy and follow very specific steps, and definitely need a professional, not only an accountant, a CPA, but an attorney as well. So if anybody's interested in this, I highly recommend getting out in front of this, because this isn't something you do last minute. You'd want to plan this out. But good news is this new portion of the qualified opportunity zone starts in 2027. So we have over a year to conceptualize and plan for it. Clean energy, this is a big one. And I know a lot of people purchase EVs, electric vehicles, solar, other energy efficient home improvement items. They're all basically gone. All clean energy is basically gone at some point this year, pretty much. So you have the EV credit, which is there have been several changes to electric vehicles over the past couple of years, and the credit amount, 30% and 75, sorry, not solar, $7,500 credit, and depending on where it's assembled, and all these different changes about electric vehicles, all of that is gone very soon. Couple weeks, September 30th. So I believe I'm reading that there's some stipulations that if you're in contract to buy the vehicle and it doesn't get delivered until after September 30th, you might be okay. But for all intents and purposes, if you you don't have the vehicle and it's not purchased before that date, there's it's black and white. There's no more credit. So really de-incentivizing purchases of electric vehicles and solar is right behind that. Solar and energy efficient home improvements. Credits for personal installations on solar are gone. No more 30% credit for a solar installation in your primary residence. There is still the possibility to take an investment tax credit if you put solar onto your investment properties. However, there's certain limitations there limited to your investment income. It's not as clean cut as the primary solar, so you wouldn't be able to put solar on your investment property and guarantee a 30% tax credit. It really would depend on your individual situation. That law still survived, but it may not translate into, again, as black and white of a benefit year one upfront as solar on your primary residence. So the solar on your primary is gone. And then another big one for investors too is that solar is no longer going to be bonus depreciable. As of 1/1/26, it is no longer considered 5-year property. We'll talk more about the asset classes and what different property means, but just to jump ahead a little bit, the assets that are eligible for 100% bonus depreciation or bonus depreciation in general are assets with a defined class life, which is determined by the IRS, of less than 20 years. So up until this point, solar was considered a 5-year asset, which means even if you don't get a credit, could at least capitalize it, bonus depreciate, get 100% write-off for it this year. That's not the case anymore after this year. It'll now be the same life as whatever the building is, like the roof basically that it's attached to. 27.5 year for long-term and midterm rentals, 39 year for short-term rentals. So almost every benefit that you can have for clean energy is gone, which is a bummer. But there's trade-offs to the other benefits that we're talking about that were included in this bill. And this unfortunately was one of them. Itemized deductions. The Tax Cuts and Jobs Act, again, referencing that is what limited the SALT cap, state and local taxes cap, to $10,000. So everybody who had high property tax, if you live in a high tax state, California, New York, or you have high real estate taxes on your primary residence, your property taxes, everybody who used to probably itemize because of these high state and local taxes that were paid, a lot of them were phased out of itemized deductions dating back to 2017 because that $10,000 cap really cut a lot of people out of itemizing. So this might not be relevant for many people now because you may be used to just taking the standard deduction, or depending on your income level, it still may not be relevant for you after the changes, but I'll mention the changes. The SALT cap is now raised to $40,000. So it is no longer 10K, it is now 40,000, but it's temporary. It's going back to 10K after 2029. However, this phases out once your modified adjusted gross income exceeds $500,000. So if you're over 500K, that SALT cap is going to start to dwindle back down to 10K. If you're over 600K, then you're at 10K again. Anything over $600,000 modified adjusted gross income, you're back down to 10K, no change, just like it's been for the past couple however many years. So for a few people, especially lower income below 500K, that's going to be relevant. For others, it may not be, depending on where you live as well. PMI is now treated as interest. That's good news for primary residents. You put down less than 20%, pay mortgage insurance. That's now treated as interest, now deductible. Once again, it used to be. It's deductible once again. Charity, if anybody has charitable deductions, this might have been a way for you to itemize in the past along with your mortgage interest because you can control how much you contribute. There's now an above the line deduction. So you don't need to itemize to deduct up to $2,000 if you file jointly, $1,000 if you're not filing jointly. You can donate up to that amount without itemizing and still get a benefit for it. So small win, but a win nonetheless. And this last bullet is a limit on itemized deductions. If you do itemize, there's now a limit if you're in the top tax bracket. So there used to be something called the Pease limitation that did something similar. It's back, different computation. It's not called that anymore, but it's basically just a limit on your itemized deductions if you're in the top tax bracket. So a way for, again, the bill to just recoup some tax cuts that were made elsewhere for the highest income earners in the country. So the calculation is a little wonky, but it's 2/37th. So this is going to be a fun calculation for us to do every time we do a tax return for somebody in the top bracket. But 2/37th of the lesser of your total itemized deductions or your taxable income that exceeds the 37% bracket. So the more income that you have, The higher you are into the 37% bracket, the more your itemized deductions will be limited until they're completely phased out and it's underneath the standard deduction. So I don't know how relevant that will be for most people now. I mean, we'll see what trends are, but it is something worth noting that if you're way into the 37% bracket and you do plan to itemize because you have either high mortgage interest or high charitable deductions, you might run into a limitation starting next year. Some miscellaneous changes. Excess business loss limitation. If you aren't familiar with this and you're looking to do major tax strategy with real estate, like short-term rentals or reps, and you have high W-2 income, this is extremely relevant. Excess business loss limitation, that's the limit that you can use, it limits the amount of real estate or other business losses that you can take against non-business income. So if you have a high W-2, that's considered non-business income. Let's say you have $1 million W-2 joint between you and your spouse, and that's reported on your individual tax returns. The most you would be able to offset with real estate or any other business losses would be 626,000 if you file jointly in 2025. And this is indexed for inflation. So it'll increase each year, but that's the most you can offset. If you have $1 million business and you're like 1099 or you're running your own business or you're a partner or a shareholder in a partnership or an S corp and you get a K1, that's considered business income. So you can have $1 million of that kind of business income and $1 million of real estate losses and offset it 1-to-1 without limitation. This limit only applies to W-2 income, portfolio income, anything that's not considered business income. So this was temporary. It once was, it went away, it came back temporarily, and now it's permanent. So the excess business loss limitation is permanent. If you have a high W-2 and you want to get to zero, might not be possible. So make sure you incorporate that into your planning or at least into your questions when you're talking with your tax advisor. Estate lifetime exemption is now 15 million. That's made permanent as well. Indexed for inflation. So that's big for estate planning. People who have high net worth. There was concern, if the estate exemption went back down to what it was before it was increased to 15 million, that would introduce a lot heavier estate planning and maybe a quicker timeline to do that. But that's a breath of fresh air, I think, for a lot of people. That's permanent now. Trump accounts. I won't spend too much time on this because this is one of those areas where we're waiting on guidance. But basically what this is a tax deferred vehicle for kids under 18. Parents can fund it. Doesn't need to be like we talk with our clients about hiring your kids, and that might be a strategy that you might have seen. Doesn't require them to be employees. You can just fund an account for your child. They don't have to earn it. They don't have to work for it, for example. And it basically functions like an IRA, like a traditional IRA. It can grow tax-free until they're 18, and then withdrawals after 18 for qualified expenses are taxed at long-term capital gain rates. So you get a benefit there. It's not ordinary rates, it's long-term capital gain rates, but qualified expenses isn't just limited to like education or like a 529 is or any like hardship or anything like that. There's a list of qualified expenses. So we don't really know exactly yet how we can maximize this, if you can incorporate this, and if like employers, meaning you as their parents, could possibly fund this as a business expense. We're kind of researching and workshopping how this could be beneficial. So more to come on this, but it is brand new. More questions than answers. But basically what it is a tax deferred vehicle for kids to build wealth for until they're 18 and take it out at a favorable rate, or possibly roll it over into like a Roth IRA is what I'm seeing too. So we'll keep up on that. Second bullet is the government is funding these Trump accounts with $1,000 for children born between 2025 and 2028. I don't know how this will function yet. I'm hearing that there might be an election to elect into it or elect out of it. I don't know how it will be funded. And I've also heard that it might be done through your tax return, or you might have to set an account up. I'm not really sure. I don't think anyone is, but it was in the law, so we're reporting it. And we'll figure out the details as they're made known to us. But that's another benefit if you have young children or plan to in the next couple of years. Could be an additional benefit. And lastly, 1099 threshold increase from $600 to $2,000. This is nice if you invest and own real estate. If you have contractors that you pay or handymen or anybody that you're paying used to be over $600 for the year, you'd have to request a W-9, potentially file 1099s. It could be an uncomfortable conversation. This is now increased to $2,000 starting in, I believe it's starting in 2026 though. So not this year, so next year. This is nice. That way, if you have, it's a little higher of a threshold. So if you have somebody come in and do a couple jobs, it may not rise to that level of requiring a 1099. So just something to keep in mind. Okay. Save the best for last. 100% bonus depreciation. It's back. There are a few stipulations and important points to consider though. And we're in September. So people who want to take advantage of this now, it's go time. So this is where we want to focus our attention. And this is exactly where, if you're looking for major tax reduction while also building your wealth and making smart investments, this is it. This is your key to check every box. So if you haven't been paying attention up to this point, that's okay. But this is the point to lock in because this is the most important part, not only of the tax law in our view as real estate tax advisors, but also from an investor standpoint. So first bullet point is really important. Assets acquired and placed in service after 1/19/25. That is a hard date. There is no flexibility. If you purchased and placed in service a property on January 18th, you are out of luck. You cannot 100% bonus depreciate it. So this is a retroactive law. It's always difficult when it's retroactive. This bill was signed into law on July 4th, which means there was basically 6 months of activity before that where we didn't know. We didn't know what the date was going to be. So somebody who might have been rushing to close right at the beginning of the year, maybe deferring a purchase into the beginning of the year and closing the first few days, is a casualty of this law, unfortunately. And it's important to note that acquired does not mean closed. It means a binding contract. So you can technically have acquired the property by contract before January 19th and closed on January 21st or January 25th. That still would not qualify. That still would not qualify because it wasn't technically acquired by definition after the 19th. So even if you were in contract, but you hadn't yet closed, that would disqualify you from 100% bonus depreciation. On to the good news. It remains 100% through the end of 2029. So that's great. We have a little bit of consistency here for the next handful of years to be able to plan for 100% bonus depreciation. And this is really important because when we have our conversations, our strategic and tax planning conversations with our clients, first thing we ask you when you onboard as an advisory client in the questionnaire that we have is, what are your goals? Short-term goals, long-term goals. And there's reasons for us asking that because we get all different answers, right? Somebody's goal might be, I need to get out of this W-2 job. Can't do it. 1 more year, 2 more years max, I'm done. Other people might be like, well, I have a 5 to 10 year runway where I kind of want to see if I want to scale back, and I'd like to be able to be financially free in 5 years and make the decision if I want to continue working or do part-time. Others may come and say, working is not the priority. I need X amount of dollars of cash flow in 3 years, after tax cash flow, and that's my goal. So when we have that definition of where your goal is, that's our starting point as the advisor to start stepping backwards, right? Making steps back. Okay, well, how do we get you to that point in that timeline with the resources you have available to you? It could be cash on hand. It could be equity in your primary residence. It could be a brokerage account or retirement account. How do we repurpose the assets that you have to get you to that goal tax efficiently in the next X amount of years? So when we have a defined 4 or 5 year period of 100% bonus depreciation, that really helps us say, okay, well, now we can go all in on an acquisition strategy, for example, reduce your taxable income significantly for the next 4 or 5 years, and really jumpstart the build out of your investment portfolio and potentially your retirement. It's more difficult in the past couple of years when we know bonus depreciation was phasing out from 100% to 80% to 60 to 40 this year before the law changed. It's harder to have those conversations because while 40% bonus depreciation is still great and very worthwhile, it's a different conversation entirely than 100% bonus depreciation. It's not as much of a jump start, not as much of an eye-opening savings. So now that we have this consistency, we can lay out a plan without that question mark or uncertainty of, what a declining tax benefit would look like for your situation. So that's really good news. As I mentioned here earlier, eligible assets that are eligible for 100% bonus depreciation must have a depreciable life of less than 20 years. So to give you an idea of what that looks like, structural components of a rental property would not qualify. Those would be 27 and a half years for long and midterm rentals, 39 years for short-term rentals. And those would be like, the building as a whole, or if you're doing cost segregation, which we'll touch on in a bit, the roof, the foundation, the walls, plumbing, electric, everything, secured flooring, those are structural components, windows. Depreciable life under 20 years are more quote unquote removables or exterior items. Land improvements are outside, so anything man-made that's outside, driveways, fences, swimming pools, retaining walls, landscaping, that's all 15-year property. It's less than 20 years, that's all eligible for 100% bonus depreciation. And you have 5-year property, and that's, again, your removables inside the house. So that could be appliances, floating floors, cabinets, countertops, certain fixtures. So there's a lot that when you go through the whole house, there's a lot that you can qualify, that you can extract, and that qualifies for 100% bonus depreciation, which is what makes this so advantageous and beneficial for investors. I'm sure we'll talk more about this when we get to the Q&A section. So I'll keep it moving for now, and we'll talk about how to take advantage of it. And that's where we're at now. So we have 3.5 months left before the end of the year. So it's still enough time to make something meaningful happen. It just needs to happen quickly. And that puts, of course, added stress on investors to find a property, because ultimately the goal is to find a property that works, right? We want it to be a good investment. Tax benefits are a bonus, no pun intended, but it's secondary. We want the investment to be good first, and then once we have a good investment, we maximize that investment with strategic tax planning. So puts a little pressure on finding a good investment. Also, as I'm sure you guys know or are learning, there's a time trade-off here. Material participation or beyond material participation for reps requires a lot of time and proper planning proactively. And that's a calendar year cutoff. So 12/31 hits, that clock ends. So finding a property, acquiring the property, smooth closing, spending enough time, putting it in service, which is different for long-term rentals and short-term rentals. Placing an asset in service for a long-term rental is just getting it available to rent. Posting a listing saying, hey, we have this property that's available to rent. You don't need to have a renter in there. That's technically in service. For short-term rental, for the short-term rental tax strategy to work, you need to actually at least have at least one stay of 7 days or less. So not only does it have to be listed, but somebody has to stay there, pay you fair market rent. So all of these have to kind of squeeze into 3 months of the year. That's a lot, but it is doable. It is doable. I wanted to give you as much information as I possibly could with a huge tax law that hit on the main points and highlight how impactful and beneficial it could really be. I had a lot of fun. Thank you guys.